welcome to everyone for joining us on this webinar. Here are the key takeaways we want you to all have from this presentation. The first one is that a lot of us, many of us here in the Bay Area, have significant appreciation from our homes. And it's important to think about how to lock in the appreciation and unlock the equity of those homes before the tax laws change. So in this presentation, we'll talk about one strategy to take the tax exclusion as a primary residence, to defer the balance of the appreciation as a rental property. And then, as Ron will mention, a lot of people have the strategy of swap until you drop. So eventually, when it passes to your heir, it's all tax exempt, but you need to have enough funds to maintain your lifestyle, your desired lifestyle. And this is one strategy to do it. The second takeaway we want you to have from this presentation is that there are a lot of intricate details in this strategy. And there's nothing, I think what you'll find that this is also a pretty robust strategy. It's simple and it's robust, but there's a lot of details that you have to manage. So you don't have to remember all the details, but what you do need to do is to remember that the planning is important, the sequencing is important, and you should work with an experienced team for the actual execution. So those are the takeaways. And of course, then once we introduce you to the team, you can ask them the detailed questions for your personal circumstances outside of the webinar. So why are we talking about this today? And I want to give everyone on the phone an example of this scenario. And like I said, this is an unusual problem in the US. Definitely a US, San Francisco Bay Area problem or opportunity. So 30 years ago, my parents, Paul and Grace, bought their primary residence for $300,000, let's just say. And, we've had some capital improvements. It is now worth more than $1.8 million. So if they don't know about this approach and they just do a conventional approach to selling their property, then when they sell the property, they can cash out the $300,000, which is their cost basis. They can take $500,000 of tax-free gain, the tax exclusion for primary residence, and then they will have to pay around $350,000 in taxes for the remaining $1 million of capital gains. And that's about 35% of tax of capital gains tax from the federal, from the Medicare tax, and then also from the California tax. So in my parents' situation, they actually needed more care and they moved in with us last year and they rented out their home already. So for them, they're getting some rental income, but it's not enough for their caregiving expenses. And they have already pretty much exhausted their liquid cash. And I think that's a common problem for many of the people in their 70s and 80s, that they have exhausted the easy ones to liquidate. So then what approach are we taking? So we're going to take this strategy we're going to be presenting today, and we're going to sell their property next spring, after 2 years of rental to 2 years of rental on their tax returns. And we're going to take out the $500,000 tax-free gain. And then for the remaining, assuming, we're excluding the sales cost and, and renovation cost and depreciation and all of that. For simplicity, we're showing that they'll sell for, let's say, 1.8. And then that means that they have about $1.3 million of balance that needs to be exchanged for the tax deferral. Then from that exchange, we're going to actually set it up so that they will exchange into something like a DST, and Ron will go into some details for that. Something like a DST, so that would be their second liquidity event once they have exhausted the $500,000 from the tax exclusion. And then from the remaining, we're going to buy another rental house in the Bay Area so that we can continue the appreciation from Bay Area to help them grow their net worth and to help them stretch their retirement dollars. And then, if they do need additional funds for caregiving, then in 6 to 8 years, we would sell that house again for additional liquidity. So, and of course, if they don't need it, then we would take that through the estate tax exemption and keep the remaining balance tax free. So with this approach, we're getting the tax free gain and then the 500,000 tax exclusion, excuse me, and then we're exchanging the rest. And this is what we're going to be talking about. But you can imagine that a lot of other people may be thinking about this. People who bought their homes, let's say 30, 40 years ago when their kids were young. Now they have a big home that has appreciated significantly. And now they're thinking, hey, they want to downsize and buy other homes or move somewhere else. Or people who are thinking of reallocating their assets, but most of their money most of their net worth is in their former primary residence. So there are a lot of different ways of using this strategy, and Ron is going to go through this presentation, this particular approach. So Ron, if you would please.
Thank you very much, Elsie. Just want to pass on my contact information. Actually, Elsie, if you do one more click on there, show my phone number. One of the reasons I want to put that up there is because unfortunately I need to leave at 1 o'clock. So if there are any questions that do not get answered, either by myself or by Elsie before then, feel free to give me a call or send me an email. I'm always available to talk to you and your clients about anything we've talked about today. So what we're going to chat about today is 1031 exchanges and how that fits in with pretty much all real estate that people own today. Now, remember, 1031 is just a tax deferral. Elsie, do you want to move forward? 1031 only defers the taxes. So you have a client who's selling a rental house. They want to sell that and buy a fourplex. So you go through the regular process of selling the property. At the close of escrow, the money comes to us as a third party. You then help them find that duplex or fourplex or whatever they're going to buy. And we send them to the money to the title company on that side. So you're selling something, buying something. Our job is to hold the money in between. And when you do, you get to defer paying taxes on the profit that you've made. Important word there, defer, not eliminate. If I sell the house to buy a fourplex, later I sell the fourplex to buy a sixplex, and now I'm tired of real estate, well, when you sell that sixplex, you pay taxes on the house, the fourplex, and the sixplex. You are just deferring paying taxes. That does not eliminate the taxes. Obviously, the longer you delay selling paying the taxes, the longer you delay selling the property, the longer you have to avoid paying the taxes completely. As a matter of fact, the ultimate goal is that you never sell the property and you pass on the property to your heirs. Your heirs gets what's called a step up in tax basis. And just to make sure we all understand this, Elsie's parents, I'll use her example. They bought the property for $300,000. Now it's worth 1.8. And God forbid that they get hit by a bus tomorrow and it passes on to their heirs. Well, when Elsie inherits that property is worth $1.8 million, and that becomes her basis on the property. The entire $1.5 million of gain that the parents had on that property all disappears when it's passed on to the heirs by inheritance. This does not work for gifting, but it works for inheritance. So all the taxes that would have been paid all disappear when you die. That's the real beauty of the 1031, is that hopefully you never have to pay the taxes. Now, there's a common term we hear in 1031 exchanges, and that term is like kind. That term is very confusing. Elsie, next slide. All real estate, all investment real estate can be exchanged with any other kind of investment real estate. So you can sell a rental house and buy a shopping center. One more slide. You can sell a farm and buy an apartment building. You can even sell bare land and buy commercial or residential real estate. Any kind of investment real estate can be exchanged for any other kind. That term like kind goes back to when we used to do exchanges for things other than real estate. So if you sold a boat, you had to buy a boat. You sold a farm equipment, you had to buy farm equipment. Those exchanges disappeared in 2017. So now 1031 is only about real estate. So that term like kind is a little bit misleading these days because it's any kind of investment real estate for any other kind. But I did say it has to be investment real estate. So as Elsie alluded to earlier, what kind of real estate is not investment real estate? Well, your primary residence. Your primary residence, next slide, is not considered to be investment real estate. Now, under Section 121 of the tax code, when you sell your primary residence, you get an automatic exemption. If you're single, you get to keep $250,000 of gain. If you're married, then you get $500,000 worth of gain. If your gain is in excess of that, then you pay taxes on that excess gain. And as Elsie talked about earlier, in the Bay Area, it's very, very common. I would say the majority of houses in the Bay Area have more than $500,000 worth of gain in them, especially if you've owned the property more than 10 years, and sometimes even less than that. So there are a lot of people who do not want to pay taxes on that excess gain, so they feel trapped in their real estate. So is there anything else you can do if you don't want to pay taxes on that excess amount? First off, does any portion of your property qualify? Do you have an ADU? You as agents may have a home office. Whatever, this is the important part, whatever percentage of the property you are declaring to the IRS as your home office or your ADU or your rented out basement or whatever, that portion of the sales price you can do an exchange on. And one thing that's becoming very common, especially on the peninsula, are people who are building ADUs into their backyards or sometimes even front yards. And so because of that, there are a lot of people these days who have a separate dwelling unit that they rent out, collect rent from, and hopefully are declaring that rent on their taxes. So in this example, property sells for $1 million. 20% of it has been shown on their taxes, whether it's a home office or rental, doesn't really matter. So 20% of the sales price they do an exchange on, and the other 80%, they still get the full $500,000 exclusion against. So again, key here is if the property is a dual use property when the property is sold, then we can do an exchange on whatever percentage of the property has been rented out. Now, the problem is most of us don't have ADUs. Most of us don't have home offices, at least that we declare on our taxes. So what do we tell those clients to do? Move out. Turn your house into a rental property. Now, after you've been renting out the house for a year or two, is that house now an investment? Yes, because you're treating it as a rental on your taxes. But is the property still a primary residence? And the answer is yes, because it still meets the criteria of having lived in the property 2 of the last 5 years. So when you do this, you get to take advantage of both tax rules at the same time. So using Elsie's parents as an example, the property sells for $1.8 million. They get to keep $500,000 because it's a married couple, and then they would need to do an exchange on the remaining $1.3 million. Now, a couple things to note about this. This does not work for everybody. If you need the money from your house to go buy a bigger house, it's not going to work for you. But if you have the ability to buy another property, or maybe you're moving in with your kids, or you're moving to a retirement community, or you have a second home that you can move into, this is a good tax strategy because it allows you to take advantage of the exemption and still do an exchange.
And Ron, we have a question from the chat. It's from Faye and Alex. They're asking how many times can one have the 250,000 to 500,000 tax exclusion for primary residence?
You could take that every 2 years. And so, in fact, this is something a lot back before these rules came into effect. When you used to have to sell a house to buy another house, there was a one-time exclusion that you could take. So a lot of people still think this 500,000 is a one-time exclusion, and that's not correct. If there's no age limit, you could do it at any age, and you could take it every 2 years. So technically speaking, you can move every 2 years and hopefully never have to pay taxes.
And Ron, there's actually another question from Jaya, and I think this goes back to the earlier homeowners exclusion that
Okay.
you referred to earlier. So the question is there an age exemption when you reach a certain age?
Right. And so before this, our current 250, 500,000 exclusion was put into the tax code in 1997, so 27 years ago. Before that, you had an exclusion that would take effect once you were past 55 years old. So that's the old rule. So a lot of people who've owned real estate for a long time, still may think that some of that is in case. That's not the case anymore. So that $500,000 exclusion, you could take no matter what age you are. There is no age minimum.
Thank you, Ron. So then we promised pros and cons, and wanted to just use this as a way to summarize why we feel this tax strategy has certain advantages for all of us to consider. On the left-hand side are the cons. One of the disadvantage of this approach is that you have to exchange all except the 500,000 exclusion if you're a married couple. If you don't, you have to pay taxes. So let's say you bought a home in the Bay Area for $1 million. Now it's worth $2 million, right? You cannot take out your entire basis of $1 million and use that for your new home. You can only take out 500,000. So in that example, that shows one major disadvantage of this approach. The second disadvantage, which I think is negligible, but it's worth highlighting, is that you have to deal with rental for 1 or 2 years. And then the third one is that a lot of people know about the Prop 19 tax-based transfer if it's your primary residence. So if you move out, turn your primary residence into a rental, and then you sell it as a rental, and then you try to take that Prop 19 tax-based transfer, it may not work. And we feel that Prop 19 is so new that that's something that you may want to check with the assessor before you implement it. Check with the assessor or check with a CPA or a tax attorney who is really familiar with Prop 19 so that you know if it will really affect you. But the key thing is that Prop 19 tax basis may not get transferred if you don't buy your new primary residence first. Okay, so what are the pros? Of course, you get to lock in the 250,000 or the 500,000 tax exclusion. That's important. But the other two things I think is probably, I mean, Ron has already mentioned this before, and I think it's worth highlighting. In this case, when you're doing this tax strategy, you can create multiple tax efficient liquidity events. So for example, in my parents' case, the $500,000 may only be good enough for 4 years of caregiving for my parents. So then they're going to be needing another liquidity events. And then down the road, that's, they may need more, so maybe in 2 or 3 years, we want to create one where they can exit or sell some more properties at a lower tax basis in 2 or 3 years, and then maybe in 5 or 6 years, we'll need to sell something else. So this tax strategy creates an opportunity for you and the family to look at creating multiple tax efficient liquidity events. And even if you join, for example, buy into a bigger syndication, you may still see appreciation, especially right now. I think on the commercial side, there may be some distressed commercial properties that you can participate in a Delaware statutory trust. And you will get cash flow from that, and then potentially you can enjoy some appreciation. Or in my parents' case, they will likely buy another single family home in the Bay Area, but just not in Santa Clara County, and there may be more appreciation. So all of the tax-free the tax exclusion or the tax-free gain, they can use to reinvest to continue to grow, and then to have multiple liquidity events to stretch their retirement. And then the third bullet on the right, the pros. Ron mentioned this earlier, and this is unfortunately all too common. We have seen parents, for example, in their 70s, 80s, they have exhausted all of their liquidity, and their primary residence is the single biggest asset that they have, $3 million, $4 million, and they have multiple kids. So the kids actually get into disputes and fight in court about who should get how much of that asset and how to make decisions. Eric and I were involved in a case last year where one brother had to borrow $300,000 to pay legal fees, just to settle the estate. And then we also worked with a client. Jean and I worked with a client recently where they were in court for 11 years to settle an estate. So I think this tax strategy also opens the door for families to consider different assets for their estate planning, so that it's easier for the heirs, for the beneficiaries to make independent decisions down the road. So these are some of the pros and cons for this approach.
So there are potentially two loans that you will need to qualify. The first one is the primary residence. So you are potentially buying a new primary residence. So there are several ways to achieve this from a financing perspective. One is actually if you have active income, you and the lender looks at your total income from your W-2 or self-employment, and it's enough to cover your obligations of all your property, including your potential car loans and other investment property mortgages. Then you're good. Then you can go the conventional loan route. That's no different than buying a new primary residence and moving it in there. Another situations that a lot of our clients run into is that they may still have active income. And in order to buy a new primary residence, a lot of people have chosen to buy first and then sell later, because the difficulty in this market is it's in the buying and identify the new primary residence. In that case, in that transition period, when they have acquired a new property and then haven't sold their existing property, they have to qualify for two loans. And that's where Abundance comes in with the solutions that provide owner-occupied bridge loan. And the benefit of this that we don't, because of the regulations provided by the DRE, we don't have to look at income, because and also it's a short-term loan. The idea is you buy based on the equity you have in your existing property and the new property combined, and move in there and then fix up and sell your existing property. And then you can pay down the bridge loan and arrange more permanent financing for them. Another way to actually finance the new primary residence is to look at whether you have a portfolio of rental property. If you have a portfolio of rental property, that's another source of income. And even though it's not your active income, it's not a W-2, it's not a self-employment income, but if the numbers work, then from a lender's perspective, it's just another form of income. Then you can go through the conventional loan route. And for some of our clients who have already retired, and if you have assets, then the lenders have some programs that allows people to use your asset as a form of income. I want to stress that you're not turning over your asset, you're not pledging your asset, and you still control your asset. You can do as you please. What the lender would do is to look at the assets that you have, look at the cash in your bank checking account, brokerage account, and also potentially your retirement account. They would say that, hey, cash is 100% of the cash is good. Maybe we'll take 80% of your brokerage account and then 70% of your retirement account. They will add up the number and then they will divide it by a number of years to come up with a quote unquote income. And then that's how they use to determine whether they can offer you a loan and at what terms. So as an example, if that number turns out to be $1 million, and then the asset depletions ranges from 5 to 8 years, that's most common. Then in the case of 5 years, then they would take 1 million and divide it by 5. Then you are effectively having an income of 200,000. And that's how that works. Another loan that you would have to consider financing options is your replacement rental property, the one your 1031 exchange into. Again, if you have active income, if the number work, then you can still go through the conventional loan route. However, if you the number don't quite work, and what you can do is that use the existing equity in your primary or new primary residence and use that to get a private money loan that Abundance can help you with, and then you can use that to finance the new replacement rental property, and down the road perhaps converting it into more favorable conventional loan. And then if you have a lot of obligations and other properties, and this route doesn't really, the conventional income route doesn't quite work, there's also a program that the lenders offer that only look at the rental property that you are purchasing. It will look at the rent on the potential rent, and then look at it standalone and see how well it covers the property, the principal, interest, tax, and insurance. So they would only consider the property, and then they would not consider your other obligations, and also would not require your income. So that's become pretty popular, and for a lot of the 1031 exchanges. Private loan option is also available. Ron also mentions a reverse 1031. Again, the situation that you will run into is that if you buy first, and then while still holding on to your existing property, the question is that how do you finance it first? That's where the reverse 1031 exchange comes in. Again, the idea is a short-term loan to help you finance it, and then you sell your existing property, pay it down or pay it off.
So Eric has presented a lot of different loan options. And I think the key thing that we want to share with you in this presentation is that it is important to work with experts who routinely address similar or greater tax consequences in the Bay Area. So if you're working like we do, we work with a CPA who's actually not in the Bay Area. He didn't even know about some of these homeowner exemptions that we were talking about, the tax exclusion, because they don't deal with it very often. So we feel that it's very important for you to network and work with people who know this strategy, who can help you implement it and implement it correctly so you don't get in trouble. So one example, we asked Ron about this question. So let's say my parents have all this equity. What if we use their equity and then we co-sign on a loan so that we own it 50-50, right? We buy a $2 million property and we use $1 million of their equity, and then we sign up for $1 million loan. Would that work? No, it would not work, because that would be treated as a partnership and therefore not a like-kind exchange. So it's details like this that you need your CPA, your tax attorney, your estate attorney, your knowledgeable real estate broker to help you navigate, so you understand, okay, what are the rules that you need to be mindful of so that you're implementing this correctly, and you don't accidentally damage your ability to qualify for an easy conventional loan by buying the properties or doing this approach in the wrong sequence. Okay, so of course, we would appreciate an opportunity to talk with you about the financing needs of this, and I'm sure IPX would be very happy to help you as well. Ron has been an excellent resource in all of our conversations about these different scenarios. And then we're happy to introduce you to the real estate brokers that we work with on a regular basis, who are knowledgeable about 1031 exchange, who are knowledgeable and who have good team of other professionals who can help you, for example, property managers or financial planners or estate attorneys. So I think it's very important to work with people who are already routinely working on similar situations with similar or greater tax consequences.